Imagine waking up one morning and realizing that the green paper in your wallet, the dollar bills you've trusted your entire life, are losing their power by the hour. Prices surge, your savings shrink, and the global economy trembles. It sounds like a doomsday fantasy, but history tells us currencies rise and fall, empires grow and fade, and confidence is the most fragile foundation of all. The question isn't if the dollar can fall, it's when, how, and what happens after. For decades, the world has treated the US dollar as unshakable, the ultimate measure of value and trust. But this dominance wasn't born by accident. It was built through war, power, and a global architecture designed to keep it at the center. What few realize is that the same forces that once secured its place, the US military, global trade, and massive financial flows, now threaten to undermine it. Beneath the surface of stability, cracks are widening. Before the dollar's reign, the British pound ruled global trade. Britain's empires spanned continents, and the pound was the lifeblood of commerce. But 2 world wars drained the empire's strength and its gold reserves. The United States emerged as the new industrial and financial giant, holding most of the world's gold and manufacturing power. By the end of World War II, the balance of power had shifted irrevocably. In 1944, representatives from 44 nations gathered in Bretton Woods, New Hampshire, to design a new global order. They anchored every major currency to the US dollar, and the dollar itself to gold at $35 an ounce. This system gave the United States a unique privilege to issue the currency that backed all others. For a generation, the world trusted that every dollar was as good as gold. But beneath that promise, the seeds of future trouble were already being planted. As the US expanded its global influence, it spent more and more abroad, on wars, foreign aid, and investment. Dollars flowed out faster than gold came in. By the 1960s, the world held more paper claims to US gold than the gold that actually existed. Confidence was high, but reality was fragile. When nations like France began demanding gold for their dollars, the US faced an impossible choice: either lose its gold reserves or end the promise of convertibility. In 1971, President Richard Nixon chose the latter, closing the gold window. The dollar was no longer backed by anything tangible. Overnight, the foundation of the global monetary system shifted from metal to trust. Trust in the US government, its economy, and its word. Freed from gold, the dollar became a fiat currency, a piece of paper with value because the world agreed it had value. The system adjusted, exchange rates floated. Oil and commodities remained priced in dollars, securing its central role. The United States could now create dollars without constraint, funding deficits and wars by printing what the world still demanded. For decades, it seemed like an infinite cheat code. Through the 1980s and 1990s, the dollar reigned supreme. America's capital markets were deep, liquid, and trusted. The US military guaranteed global trade routes. Investors from Tokyo to London parked their wealth in treasury bonds, confident that the dollar was the safest harbor. The network effect was unstoppable. The more the world used the dollar, the harder it became to replace it. Yet power breeds complacency. The privilege of printing the world's currency encouraged spending beyond means. The US ran ever-growing deficits, borrowing from the same nations that depended on the dollar. Foreign central banks, especially in Asia and the Middle East, accumulated mountains of US debt. The dollar system kept running, but like an engine with hidden cracks, pressure was building. By the 1980s, even allies began to complain that the dollar was too strong, distorting global trade. The Plaza Accord of 1985 marked a rare moment of coordinated intervention where major economies agreed to weaken the dollar. It worked, temporarily, but the fundamental pattern, US deficits financed by foreign savings, never changed. Each cycle of rise and correction left the global system more fragile. When the Soviet Union collapsed in 1991, America stood as the sole superpower. The dollar seemed untouchable. Through globalization, the US exported its financial system to the world. Trade, debt, and oil, all in dollars. even countries that distrusted Washington had no alternative. This was the golden age of the petrodollar, and for a while, it seemed eternal. But the 2008 financial crisis changed everything. The world watched as the very institutions built on the dollar nearly imploded. Trillions were created out of thin air to stabilize markets. The Federal Reserve became not only America's central bank, but the world's lender of last resort. The crisis ended, but the illusion of invincibility was shattered. Trust, once fractured, never fully returns. After 2008, the US relied increasingly on low interest rates and massive debt to sustain growth. Foreign holders began to question whether endless money creation could continue without consequence. Slowly, countries diversified, buying more euros, yuan, and especially gold. Each small move looked insignificant, but together they signaled a quiet shift in the world's financial gravity. The next shock came in 2020, when the global pandemic forced governments to unleash unprecedented stimulus. Trillions more dollars flooded into circulation. For a time, the dollar strengthened as investors sought safety. But as the crisis faded, inflation returned with a vengeance. Prices climbed, interest rates rose, and the cost of maintaining America's debt ballooned. The strength of the dollar began to look like a double-edged sword. By the mid-2020s, a pattern emerged. Nations increasingly settled trade in their own currencies or through regional alternatives. The dollar still dominated, but its share of global reserves slipped below 60%. In historical terms, that's still overwhelming, but trends matter more than snapshots, and the trend was unmistakable. The world was hedging against a single currency future. The danger is not that the dollar suddenly collapses overnight. The real risk is the slow erosion of confidence that precedes an abrupt tipping point. Once major holders believe the dollar's best days are behind it, they act defensively, diversifying reserves, shifting trade patterns, building new systems. These decisions compound, accelerating the decline they were meant to guard against. If that confidence breaks completely, the consequences could be severe. A weaker dollar would make imports more expensive, driving inflation at home. Foreign investors would demand higher interest rates to hold US debt, deepening fiscal pressure. The American government, accustomed to cheap borrowing, would face hard choices: cut spending, raise taxes, or print even more. None are painless. Globally, the shock would be enormous. Because the dollar underpins trade and debt markets everywhere, a sudden loss of trust could trigger cascading crises. Emerging economies that borrowed in dollars would see their obligations explode. Global supply chains could seize as liquidity dries up. Financial systems built for stability would face chaos. The world might be forced to rebuild its monetary architecture from the ground up. History shows that reserve currencies rarely fade peacefully. The British pound's fall took decades, but it brought turmoil along the way: banking crises, recessions, political realignment. If the dollar follows a similar path, the 21st century could witness a similar transformation. The question is not just which currency replaces it, but what kind of world emerges when the old order ends. Some argue that no rival can truly replace the dollar. The euro is politically fragmented, the yuan lacks convertibility, and digital currencies remain experimental. But history has a way of surprising us. Power often shifts not through strength of the challenger, but through weakness of the incumbent. The fall of dominance usually begins from within, from complacency, debt, and declining faith. If the dollar loses its unique role, the United States would lose more than financial privilege. It would lose geopolitical leverage, the ability to impose sanctions, influence trade, and finance its military reach with ease. The balance of global power would shift toward a multipolar world where influence is divided and trust becomes regional rather than universal. Attempts to preserve the system might only delay the inevitable. History is filled with agreements: the Smithsonian, the Plaza Accord, the IMF's interventions that temporarily stabilized currencies, but never reversed the deeper forces at play. Each fix bought time, not safety. The underlying issue is structural: too much debt, too much money creation and too little accountability. There are three clear lessons from this unfolding story. First, no currency's dominance lasts forever. Every empire believes its money is eternal, until it isn't. Second, short-term market swings matter less than long-term imbalances. Fiscal deficits, trade gaps, and political confidence determine fate. Third, the fall of a reserve currency doesn't just affect governments. It reshapes ordinary lives through inflation, interest rates, and job markets. The greatest danger is assuming it can't happen here. The moment a society stops questioning the foundation of its money is the moment vulnerability grows. When the dollar dies, whether suddenly or gradually, it will not be a single event, but a process. And by the time the world realizes it's happening, the process will already be irreversible. Perhaps the dollar will endure for another century, adapting to a new digital age. Or perhaps it will fade into one of several global currencies sharing power. Either way, the story is far from over. The next chapter will test not just America's financial system, but the world's faith in what money really is. And so we end where we began, with a question. When the dollar dies, what happens next?